Welcome to the deep dive. Today we're taking a shortcut to getting really well informed on something that often feels a bit mysterious: stock market timing.
Right.
Many of you are probably curious about navigating the ups and downs, and our mission today is to pull out the key ideas from a really fascinating source, the ultimate book on stock market timing cycles and patterns by Raymond Merriman.
That's right. Merriman's work is pretty significant because it asks a huge question. Can you actually consistently nail those market turns?
The exact moment.
Exactly. What he calls crests and troughs. And this book, it lays out a methodology. It uses math, formulas, cyclical patterns,
Yeah.
all to pinpoint probable future turning points.
Finding the market's rhythm, you could say.
Precisely. Finding that hidden rhythm.
So this is definitely not just buy and hold then, is it?
Oh, no, not at all.
This sounds much more active, like getting into the dance of the market. What got Merriman so focused on this particular area?
Well, his inspiration really comes from this belief.
Mm.
While a lot of analysts see markets as just random chaos, Merriman thinks there are underlying repeated patterns. You just have to find them.
Okay.
And this book, it's actually part of a 5-volume series. It focuses mainly on the big U.S. indices, the Dow, the S&P 500.
Standard stuff.
Yeah. But he also dives deep into the Japanese Nikkei and other Far Eastern markets, too. He notes that they have this remarkably rhythmic behavior, almost predictable.
Interesting. Okay, let's try and unpack this a bit. When Merriman says cycle in financial markets, what does that actually mean? And why is understanding it so key for timing?
Okay, so at its heart, a cycle is just something measurable, a pattern that happens again and again at fairly regular intervals.
Right.
You mark the start of one cycle from its trough, that's a low point, to the next trough. That's one full cycle.
Okay, trough to trough.
Exactly. And crests is the high points within the cycle. Understanding these helps you define sort of the start and end of market moves, like breathing in and breathing out.
So it's not just a perfect wave, though, right? You mentioned distortion. Merriman talks about cycles getting distorted. How does that affect things?
That's a really important point. Yes, cycles can be distorted. They can unfold differently, meaning they might show up early or late compared to their average timing, or the cycle itself might stretch out longer or get compressed shorter.
Okay.
Variability.
Exactly. That variability is key. You have to expect it. He also shows basic patterns for bull and bear markets, how these movements usually look, often in 3-phase or 2-phase patterns.
Okay, and I saw he talks about right translation and left translation. Those sound kind of technical, but important. How do they signal strength or weakness?
They are very important. It's all about reading the inside of the cycle. So right translation happens when the cycle's crest, its peak price, appears after the halfway point of the cycle's time duration.
Okay, later in the cycle. Right. Think of it like the market is still pushing higher well past the midpoint.
Okay.
It suggests strength. Usually bullish prices will likely make a new high later.
Got it. And left?
Left translation is the opposite. The crest happens before the midpoint.
Earlier.
Yes, it suggests the upward momentum is fading early. It often points to a bearish outcome. Prices probably won't get past the last cycle's high. And get this, if you see 2 primary cycles in a row with left translation, that could be a strong confirmation that you're actually in a bear market.
Wow. Okay. That's a specific signal. So stepping back to the bigger picture, Merriman identifies these really long-term cycles. What's the longest one he points to in U.S. stocks?
He talks about a possible 90-year cycle. 90 years.
90. Wow. How far back does that research go?
All the way back to 1789.
Seriously.
Yep. Looking at data over centuries. And within that, there seems to be maybe a 45-year subcycle or something a bit longer. When you look at those long-term charts, you really see these major highs and lows repeating over vast stretches of time.
That's incredible context. And what about the Kondrativ cycle? I've heard that name. Sounds like some huge economic force.
It is the 54-year Kondraty cycle. Merriman brings that in, too. It's based on the work of Nikolai Kondrativ, a Russian economist.
Right.
It basically views economic history through these big waves, these themes: growth periods, agricultural shifts, waves of invention, changes in trade, even war impacts.
Like grand themes of history.
Pretty much. And this cycle, roughly 54, 55 years, helps explain some really long market swings. Like he notes the period from 1877 to 1932 was 55 years. A long down wave.
Fascinating. Okay, so building on that, the 18-year cycle feels maybe a bit more manageable, like a bridge between the huge cycles and something more practical.
Exactly. The 18-year cycle in U.S. stocks is a really critical framework. and it highlights a key idea of Merriman's. Every big cycle is built from smaller ones.
Like Russian dolls.
Precisely. He breaks it down into like 2.5-year, 4.5-year, 5.5-year, 12.5-year cycles, all fitting together into the 18-year. And that 18-year often fits into a 36-year cycle.
Okay, so it's layers upon layers.
Yes. And the main point is, to really get the trend of any market, you first need to figure out where the current cycle fits within the bigger cycle above it. Context is everything.
Right, context. Okay, so for many of you listening, here's maybe where the rubber meets the road. The shorter cycles that might offer more frequent clues. What about the 4-year cycle in U.S. stocks? How reliable is that one?
The 4-year cycle. It's incredibly important for more active timing. Studies show its average length is around 36.7 months, so just over 3 years. Median is closer to 38, 39 months.
Okay, about three and a bit years. And performance.
This is what's really compelling. The average price increase from the trough to the crest of a 4-year cycle, historically, is over 100%.
Doubled. On average.
On average, yes. And get this, over 80% of the time, the gain was more than 50%. 4 out of 5 times, over 70%.
Wow.
So it underscores its historical reliability for potentially significant upward moves. It's not just theory.
Okay, that's powerful. And does this cycle have typical shapes? You mentioned phases earlier, 3-phase, 2-phase?
Yes, exactly. The 3-phase pattern is dominant in the 4-year cycle. It shows up in like 86% of the cases studied.
So most of the time, what does that look like?
Typically, you get an initial bullish phase, then 2 more distinct phases after that. Even the big 1929-1932 crash, interestingly, showed a clear 3-phase pattern on the way down.
Even in a bear market.
Yeah. 2-phase patterns happen too, just less often. Another useful bit, the decline in that final phase of a 3-phase pattern. It averaged only about 7.4 months, relatively short.
Good to know. And these cycles, they're not just a U.S. thing, right? You mentioned Japan earlier. Do they see similar patterns?
Absolutely. His analysis of the Japanese Nikkei confirms these same kinds of cyclical characteristics are present there too.
Okay.
Beyond the 4-year, he found a really prominent 24-month cycle in Japanese stocks. Average length about 25.7 months, so just over 2 years. And also a 17-month cycle, median around 16 months. What's fascinating is seeing how these different short-term cycles overlap and interact. Creates a complex rhythm, sure, but it is a discernible rhythm.
So the principles seem universal, even if the exact timings differ market to market.
That seems to be the case, yeah.
Yes. Okay, so we have the cycles themselves. But what else does Merriman use to help confirm these turning points? You mentioned technical analysis.
Indeed. He doesn't rely only on cycle counts. He integrates 6 key areas from technical analysis to basically complement the cycle studies.
6 areas, like what?
Support and resistance levels, classic chart patterns, moving averages, overbought, oversold oscillators, and 2 really important ones, intermarket divergence and oscillator divergence.
Okay, those last 2 sound interesting. Let's take intermarket divergence. What is that, and why does it matter for timing?
Intermarket divergence is it's a really powerful concept. It's when different but related markets start moving in opposite directions.
Okay, like what? Give me an example.
Sure. A bullish example might be, say, S&P futures are ticking up, making higher lows, but the Dow Jones Industrial Average actually dips and makes a new low.
So they're disagreeing.
Exactly. They should normally move together. When they diverge like that, it can signal that a reversal is coming in the market that's lagging behind, in this case, the Dow. It's like one market is giving you a heads up about the other.
Okay. And bearish divergence.
Same idea, just flipped. S&P futures falling, making lower highs, while the Dow pushes up to make a new high. It suggests the rally might be losing steam internally.
Got it. A potential warning sign. And the other one, oscillator divergence. What's the key insight there? You mentioned tools like RSI or stochastics.
Right. So this brings momentum into the picture. Oscillator divergence happens when the price itself makes a new high or a new low. But a momentum indicator, like the RSI Relative Strength Index or stochastics, fails to make a matching new high or low. It diverges from the price.
Okay, so price goes higher, but momentum doesn't confirm.
Exactly. That's bearish divergence. Price makes a higher high, but the oscillator makes lower high. It suggests the upward thrust is weakening, even though price is still inching up, often precedes a top.
And the opposite for lows?
Correct. Bullish divergence is when price makes a lower low, but the oscillator makes a higher low. It's saying, hey, the downward momentum is actually fading, even as price makes that new low. It's often a signal before a bottom.
So these divergences act like triggers near the expected cycle turning points.
That's a good way to put it. They are crucial triggers or confirmations for identifying potential cycle crests and troughs. They show the internal strength, or lack thereof, behind the price move.
Okay, this is fascinating stuff. But it's not just theory, right? How does Merriman suggest people actually apply this? Different types of investors, maybe?
That's right, he connects it directly to strategy.
Yeah.
He outlines how different styles can use this.
Okay, like for a really long-term investor, someone thinking 10 years out or more.
For them, the 18-year cycle is the main guide. The big advantage historically, at least between 1932 and 1995, when you look closely, was there wasn't a single losing year if you held through the whole cycle.
Wow. But the catch?
Patience. You have to ride out some potentially big, scary declines within that long upward trend.
Right. Okay, what about someone more active? A position trader, holding for weeks or months, maybe up to a couple of years.
For the position trader, the 50-week cycle becomes really important. It helps define the major trend they're trading within.
So about a year-long cycle.
Roughly, yes. Using that helps with better entry and exit timing, avoiding some of the larger drawdowns, but it definitely takes more work, more study.
Makes sense. And then the really short-term trader, days to weeks.
For them, that same 50-week cycle is still fundamental, but more as context. It tells them the direction of the main tide they're swimming in.
Ah, so they know if their short-term trades are with the trend or against it.
Precisely. It helps filter trades, offers more action, potential for quick profits, sure, but also more stress, more noise to navigate.
So across all these styles, what's the fundamental principle Merriman pushes for actually building wealth using cycles?
The core idea he emphasizes is actually quite simple, conceptually at least.
Yeah.
Buy in the first phase of a cycle and sell in the last phase of a cycle.
Buy early, sell late in the cycles pattern.
Essentially, yes.
Yeah.
It's based on that observation that cycles tend to unfold in these predictable phase patterns, 2, 3, maybe even 4 phases. By aligning your buying and selling with these expected phases, you tilt the probabilities in your favor.
Operating based on historical odds.
Exactly. Trying to work with the market's natural rhythm instead of constantly fighting against it or guessing randomly.
What an incredible deep dive. Seriously, from those huge Kondratief waves down to the little ticks on an oscillator divergence, it really is a shortcut to getting your head around a complex topic.
It is, and I think the real value Merriman brings is showing a way to turn all that market information, all that noise, into potentially actionable knowledge. This framework, it encourages you to look past the daily headlines and search for those deeper underlying rhythms.
Seeking the pattern beneath the chaos.
Yeah. And, there's always more to learn, but recognizing these patterns, it can definitely enrich how you understand market behavior.
So for you, our listener, here's something to chew on. If markets, as Merriman persuasively argues, really do move in these discernible cycles and patterns, what might that imply about other complex systems you see?
Good question.
Other things that seem chaotic, economic, social trends, maybe even nature, could there be hidden rhythms there too? Something to mull over.